Okay, so in this video, we're going to go over how to start investing in stocks for people who live in Canada. A little bit about me. I'm a 34-year-old Canadian investor saving for my retirement, as I do not expect to have a company pension. So I'm thinking in my retirement, about 30 years from now, I want to have a bunch of money that I can either withdraw from or make a little bit of money from dividends to pay for my existence, my life, when I'm no longer working. So I primarily invest in my tax-free savings account right now. I use Wealthsimple Trade, and I also have a little bit of money in Quest Trade and a little bit of crypto also within Wealthsimple. I'm not a financial advisor, and this is not financial advice, but hopefully it's helpful information if you're interested in how to get started investing in Canada. So in this video, we're going to first talk about a bit the mindset about investing, some strategies that we can go over, some really basic stuff, how to research stocks and which brokers to use, like how to actually buy the stocks. And then we'll finish off with a little bit of an example on how to track your portfolio once you get started. And that should be good for this video. And hopefully you, by then, know a little bit about how to buy stocks. So, talking about mindset first. If you were thinking about investing, it's good to first have an emergency fund. So basically, if you have all of your needs met, you're able to pay your rent and all of your expenses every month. That's great based on your income. But before you start spending any extra money on stocks, it is a good idea to have an emergency fund. So some people say it's good to have up to 6 months expenses saved away, kind of like in cash in a savings account or something like that, in case you lose your job. Because if you had all of your savings in stocks and you lost your job and you needed access to money, you would have to sell those stocks to get the cash, and the stock market might be down at some particular moment, right at the worst time, and so you might actually lose money. So it's better to have a little bit of cash going forward, and then once you have some cash and all of your needs met, that's probably a good time to start investing. And then after that, once you have you feel like you're ready to start investing, I guess you just have to decide how much you want to invest and how often. So, like, do you want to put $100 a month, or $100 a week, or $1,000 a month, or $1,000 a week, whatever. It could be anything. You could put it in $5 a day, $5 a week. You can get started with anything. But it's just good to kind of think and balance your amount of money that you have with how much you want to put away for investing, because a lot of people are investing. If you're like me, you're investing for retirement. And so this is money that you're hopefully not going to touch for a very long time. Of course, you can sell your stocks at any point and get some money back. But like I said, you might be needing cash when the market is down, which might not be a good time to access it. So in general, you want to probably assume that you're going to be investing money that you don't need at all for like a couple of years at least. The general idea here as well with your investments is that you want to end with more money than you started with. So if you invest $1,000 today, by the time you retire, or by the time you're ready to access that money, you're really going to hope that it is worth more than $1,000 when you withdraw it in the future, because that's kind of the point. You invest money to make money. If you put in, let's say, $10,000 today, and 4 years from now, if something bad happened in the market and you have $8,000 and you withdraw it, well, you just lost money, and you would have been better off not having put any money in the stock market anyways. So this is just an idea. You want to finish with more money than you started with. And also, we want to beat inflation. So money loses value over time, typically. And the government of Canada, I think, specifies that it is around, their target is around 2% inflation per year. So basically, every year your money gets like 2% less valuable, and that's why wages are always increasing. It's why everything is always getting more expensive. It is because of inflation. Like your parents might tell you that back when they were young, they bought a can of Coke for like 5 cents or something, and now it costs like $2. And even 10 years ago, it cost like $1. So it's just stuff gets more expensive all the time. And if you think that you want to retire today, if you're thinking today about your retirement, if you want to have $1 million or something, because that way at 5% of dividend, you could have like 50,000 per year in cash flow, or something like that. You have to remember that when you retire, let's say it's maybe 30 years from now, like me, that $50,000 probably won't have the same value as it does today. Or sorry, $1 million won't have the same value as it does today, and the yield that I would get off my dividends or something like that wouldn't get me as far, because the money will be worth less. So right now, if I'm thinking my target is $1 million in today's dollars, in reality, it's probably going to have to be more than $1 million by the time I reach 60 or 65 or something like that. Okay, so there's a few different strategies when you're buying stocks or investing. The first one that we could talk about is growth stocks. So if you just want to maximize your returns, and just get the most money possible, you'd be going after growth stocks. And these are often tech companies. We can look at some examples here like Meta or Facebook, basically. Aside from what happened recently, they are companies that just experience like huge amounts of growth over relatively over their lifetime. Other ones might include something like Google, that just have these like crazy trajectories going up to extremely high values, coming from much lower numbers, or something more closer to home like Shopify. Again, a lot of tech companies recently crashed, but before that, they were experiencing like crazy growth compared to other stocks, like more traditional, like boring stocks or something like that. And with all of that potential reward, definitely comes some risk, as we see some of them recently crashing. If you're into something a little bit more safe, you might be interested in dividend stocks. So dividend companies are those that basically they pay you cash into your brokerage account, like every 3 months or once a month. It depends on which one. But they're basically going to pay you a dividend, which you're going to hold the company. Let's actually take a look at one like Fortis. So the stock price of Fortis, you can see here, goes up generally over time, but also every 3 months they're paying you a dividend. So every share that you have, they're going to pay you this distribution. So 32 cents for every share that you own, and then the next time it was 34 cents, and then the next time was 37.5 cents. And so not only is the stock price going up, but this dividend, they're just giving you money as well just to hang on. And in some companies, it is going up, the payments per share. And that's what we call dividend growth, which the longer you hang on, the more you're going to get per share that you hold, which can be a great strategy for some people. And if you reinvest that money, you can get the compounding effect. Whereas other people are more interested in income investing, just going after very high yield stocks, like for example, this one called Dividend 15 Split Corp. This is just one example, but they're yielding 16.53%. Fortis was yielding something like 3%. And so every year they're going to pay you 16% of the basically today's share price per year in cash, which is very high. And if you look at the chart here, we can see that these payments are the stock price in general for this company is kind of going down over time, and these dividends are staying consistent. So they're always paying the same amount per share per payment, which can be awesome if you are like in retirement and you just want cash flowing out of your account. But you do have to be also careful that, thinking about if you put in like $1,000 here, and then later you pulled out your money down here somewhere. Is it more money than you had when you started? And it might be based on adding up all of these dividends that you got paid, and it might not be. So it's just something that is worth checking out, and it depends on your own goals as an investor. And then another popular strategy is like index investing or just buying huge ETFs that kind of cover everything. This is super diversified, and you're going to pretty much get exactly what the market returns are. You're not going to be trying to beat them or maybe get less. So for example, you could be looking at an ETF like this, which is like the Vanguard S&P 500, which pretty much just follows the 500 biggest companies. And it generally goes up, and it also pays a dividend, which is a pretty safe thing to do. There's like 500 different companies tracked in this, and there's some managers somewhere that choose what's in here, and you're going to pay maybe a small little fee, but that's just, you're not even going to see that coming out. It'll just kind of be taken away outside of these profits, and the stock price reflects that. So that's just generally considered a very safe way to invest, and is popular for a lot of investors. You can buy this via fee.to, just like you could buy any other share in a company. Like for example, if you wanted to buy Fortis, these are just the tickers of the companies and are what you would look for in your broker when you're going to buy shares. Okay, so when we start getting into researching what stocks we want to buy, Yahoo Finance is a great place to check out some of the basic trends and information of these companies, like we've been doing already in this video. So you can come into the summary, get a good idea of, is it going up or is it going down? That's a very good thing to be aware of first. In general, for the max time chart, you can look at this in different time durations. So how's it been doing in the last year? This one has been going down in the last year, but it's been going up over the last 5 years. And we can compare this to other companies and get just a rough idea of what's going on. Generally, it's a good idea to buy stocks that go up, because then when you sell it later, it might be worth more than you bought it for, which is kind of one of the goals. You can also get familiar with some of these terms And even just Google some of these things, like what is a stock beta, what is a PE ratio, and just get familiar with these and then compare them to other companies that are similar and see if that is favorable for you or not. And in general, you can come in here in Yahoo Finance and just get an idea, like you can look at the finances. Is the revenue and the earnings going up or is it going down? Are analysts suggesting that you buy it or not? In this case, it's a complete mixed bag. And then you can read some news articles, get familiar with what they're doing, even the company description, just get a general idea of what this company is doing before you consider buying the shares. Another great resource for Canadian investors, particularly those who are invested in dividend investing, is dividendearner.com. This is an awesome website that has a ton of really good lists of Canadian stocks with some information about them. For example, here's one article that they have about the Canadian dividend aristocrats, where they're just basically good dividend stocks to have. And they got a whole bunch of information here and then just lists of stocks that you could consider buying. They also have lots of other articles here, like the best energy stocks, the best bank stocks, best income stocks, and this is all focused for Canadians, which is a really great resource to start wrapping your head around what you might be interested in buying if you're going to be buying some stocks. And then there's a whole bunch of other online resources that you can use, including Google Finance, Wallmine, MarketBeat. These are basically just websites where you can type in a ticker once you already have an idea, maybe like now that you've read the best top Canadian bank stocks, you want to research those a little bit more in detail, one at a time, you can drop the ticker into Google Finance, Wallmine, or MarketBeat or something like that, and it's very similar to Yahoo Finance, and you can just get a lot of different information and kind of see if it's something that you might be interested in spending your money on, or something you think that you will be able to make some money off of. Okay, so now when it comes time to actually buying stocks, you need what's called a broker. This is like an app or a website that you can access on your computer or your phone, where you can actually make transactions and buy stocks. So you can add in money from your bank account, it will go into the broker, and then you can use that money to buy stocks, to buy ETFs, stuff like that. I personally use Wealthsimple Trade for most of my investing. I like them because they have no trading fees. So you can just buy like one share. Say you buy a Fortis share, it's like $50. It will cost you $50, and that's it. And now you just have it. If you want to buy US stocks like Tesla or Amazon or Meta or Google or something like that, you're going to be paying 1.5% currency exchange, which is not very favorable. But as long as you're buying Canadian stocks, I'd say Wealthsimple Trade is your best bet, especially for just getting started. It's really simple, and I will put a link to a video at the end of this one that shows you how to use it, and it is very straightforward, and there are links in the description below as well to get started with it. Questrade is my second choice. I actually have a Questrade account as well with a few shares there, not too much. But it's just money that I wanted to keep separate from my Wealthsimple Trade account because I have all of my money in my tax-free savings account in Wealthsimple. And then in Questrade, I decided that's where I wanted to start having some of my non-registered accounts or cash accounts. But there you're looking at $4.95. So basically $5 to $10 per trade. So when you buy, they're going to take $5 to $10. And when you sell, they're going to take $5 to $10. It depends on how many shares you buy at a time. And it can vary with them a little bit. But you will never spend less than $5 basically. Unless you're buying ETFs, which are $0 to buy, but you're still going to have to spend that $5 to $10 to sell them. Whereas the bank brokers, something like TD Direct Investing or Scotiabank iTrade, they're starting at $10 per trade basically. And this is just money that's going to leave your account and you're never going to see it again. Again, it's why I like using Wealthsimple Trade, because imagine the situation where you just buy one single share for $50. Like the share costs $50. So if you use Wealthsimple Trade, you invest $50, and then after the transaction, now you have one share worth $50. But with something like a bank broker that charges $10 per trade, if you wanted to buy one single share of $50, you would actually have to spend $60 because you're going to get the share for $50, plus they're going to charge you that $10 fee for the transaction fee. So you're basically losing like 20% of the value right there if you're buying a small quantity. So when you're using these other brokers that charge commissions, you essentially need to buy much higher quantities, or you should buy much higher quantities. Like for example, if you spent $1,000 and you got like 20 shares of that $50 stock, they would still charge you $10 for that trade, and $10 is like 1% of 1,000. So you would basically have 99% of your initial investment after they take the commission. or you basically would have lost 1%. But that's spending $1,000 at a time. Whereas if you're spending like $50 at a time, they're going to take like 20%. So it's really something to be aware of. And if you were to like sell that stock right away after, so you took your $1,000, you bought 50 shares of this company or 20 shares, whatever, they take 1%, they take $10, which is 1%, and then you sell it again, they take another $10. So basically, by the time you buy and sell at that same price, you've already lost 2% of your investment, which is kind of not great, because if there was a broker that didn't charge you fees like Wealthsimple, you can just trade money in and out and you're not losing money on everything. So they're definitely all worth researching, but my recommendation or my personal favorite is Wealthsimple Trade, followed by Quest Trade, and there are links in the description below where you can get started with these. And like I said, I'm going to put a video at the end of this one where you can see what it's like actually putting in money and buying shares in Wealthsimple Trade and see if it's something that you might like to try. So once you've got your money, you picked a broker, and now you've put some money into that broker and you've been buying and selling some shares as you go. It is important for you to be able to track your performance, because most of the time, generally, you want to come in and you want to see a number that's bigger than what you started with, because that means you're making money. So if you put in $1,000, when you want to come and check in, you want to see that you have more than $1,000. And your broker will tell you this information. It's going to give you the account total, and it's also going to give you like each position total. So if you bought a few shares of company A and a few shares of company B, and company A goes up and company B goes down, you'll be able to see that on each of those. So actually, let's jump into my broker and we can take a look. So it's giving us the account total. It's telling us that all time we're up 1% or $665, which is good. And then in each position, which is like each different share or company that I own, we can pop in here and I can see like that on this particular stock, I'm actually down pretty far on that one. Or on another one, I might be up. So for example, this company, I'm up, and I can see that like some companies are up, some are down, and we're also got a little bit of basic information in here about what's going on. But sometimes in the brokers, that information is pretty limited. There's just a few items there. And if you're interested in really digging into how your portfolio is doing, or just to kind of be more aware of what's going on, you might be interested in using a spreadsheet. So you can either make your own for sure if you're good with spreadsheets, or you can buy one. And basically, depending on which one they are, they can be very advanced or very simple. I'll show you the one that I use. So it's here. It has a lot of similar information, but a little bit more detailed than what we see in the broker. We can also see the same numbers here, like I'm overall up $665. I can see all of the monthly dividends that I've received over time, the breakdown of my holdings and sectors. Then I have a lot of sheets in here for my portfolio, so I can quickly scan like what's going on each individual position. I can see here that my overall account is up $665. So the amount of money that I deposited is less than the amount of money that I have right now, which is good, which is what I want to see. I can also see in here that like this is the amount of future income that I'm going to get from my dividends, because most of these are dividend companies. But I can also come in and per position quickly look at all of them together and see like which companies are up and which are down. Which ones are my bigger positions making up a bigger piece of my pie, and which ones are smaller, and then all sorts of different information in here. So this is a good reason to be using a spreadsheet. Like this one has a lot of different features, and this is one that I made, but it's also available for you if you want to track it and try downloading it and using it for your own portfolio. And there's a link in the description below, and also a lot of my other videos always show this spreadsheet, so you can kind of get an idea on how to use it by watching them, and there are also some tutorials and stuff that come with it. But in general, it's good to just have a good idea of what's going on inside your portfolio, because this might be your life savings, or it might be a significant amount of money tied up in stocks that you really want to know if it's doing well or not. So that's a good reason to be tracking your portfolio once you get started. So hopefully that is helpful and gives you a rough idea of how to get started with investing in Canada. And if you're interested in actually trying out or kind of seeing how Wealthsimple Trade works in particular, watch this video here. You can just click it on the screen, and it'll show you an example from my portfolio where I just put in some money into Wealthsimple and buy a stock. And you're going to see really how easy it is to get started.